transaction value. So the power has been given to the government to come out with a, notwithstanding that there is a transaction value, but the government has notified, yes, this is the value on which you are liable to pay the taxes. As you are aware, whenever we arrive the value, the value will be towards the construction services, the value will be towards the supply of land. So whenever you enter into an agreement as a real estate developer, if I enter into an agreement with the buyer, I am going to collect the consideration towards the supply of land and towards the supply of construction services. So whether I should apply the transaction value mechanism, or is there any other value which is notified under the GST law? So as you are aware, the rate notification has very clearly stated that whatever the value you are going to collect it, on that gross value, 1/3 abatement will be given towards the supply of land. So artificially, the gross amount charge, the value, the notified value has been arrived for the purpose of real estate to compute the taxes. Irrespective of your value of land, irrespective of your actual value of land, the law has come out with a mechanism of arriving the land value as 1/3 from your total consideration. So I think this we have to be very careful whenever we are going to look from the tax perspective and the value which we are going to arrive under the GST law. The next 148 and 164, I just want to bring to the notice that whenever we read the notifications, we have to understand that is it brought under section 148 or is it brought under 164? So this rule 42 and 43, they have brought it from the perspective of section 164, because section 164 is wherein the government has been given the power to make the rules. So even the power is given to make it retrospective, but here for rule 42 and 43, they have said it is effective from 1/4/2019. So whatever the amendment has happened, it has been clearly stated in the notification 16/2019 as it is effective from 1/4/2019. So I think we have to understand whether it is brought under any rate, this rate of taxes are brought under 148 or 164, we have to understand, because under 148, even the government has been given power on the recommendation of the council to make a special provision for registrations, for furnishing of return, payment of taxes and administration. I really believe that the government should come out with a special provisions for real estate. They have to come out with a special chapter for a real estate, because rather than bringing out from each chapter a part of the analyzing of taxes, I think they have to bring out with a separate chapter for real estate. But I think as on date, they have just brought into the tax rate, otherwise we have a regular registration procedure, regular furnishing of return and regular administration. So there is no such special provision for real estate. Then understanding this 164, we have understood that it has been brought under 164 for amendment of rule 42 and 43. I think I thought before going into the input tax credit, I just want to make aware to the members what were the notifications which were implemented from, which were introduced from 1/4/2019, that is notification 3, 4, 5, 6, 7, 8, 16, 4/18 and 23/19. So I just want to bring to the members what was that notification which was talking, because this notification is attached with the conditions of input tax credit. For example, notification 3/2019, it is in reference with the 11/2017, which is talking on change of rate of tax. So whenever you are going to look into the change in the rate of tax, simultaneously they have attached the conditions with that. What are the conditions if you are going to opt for the change in the rate of tax? So one condition is that you are not eligible for input tax credit. The first condition they have added. The second condition is that you should make 80% purchases from registered supplier. It means the rate of tax is conditional. The rate of tax is attached with lot of conditions. So accordingly, we have to look that, yes, if I'm opting for this new rate of tax, or if I'm opting for what kind of rate of taxes, accordingly, the input tax credit has to be worked out. So very, very important is, first of all, before going into the aspects of input tax credit, we have to read notification 3/19, which is talking on change in the rate of taxes with the condition attached from the perspective of input tax credit also. Then section notification 4/2019 is speaking on exemptions which are applicable. Notification 5/2019 is talking on reverse charge. notification 6/2019 is talking for point of taxation, at what point of time the developer is liable to pay the taxes, the landowner is liable to pay the taxes. All that point of taxation has been discussed in 6/2019. In 7/2019 and 8/2019, they have basically discussed from the perspective of this development rights, and they have discussed from the perspective of 9.3 and 9.4. So these are the special notification for reverse charge, which is applicable only for the real estate industry, that is from the perspective of construction services. Notification 16/2019, I think that is the eye-opener notification, which has brought a huge amendment in the GST rules from the perspective of Rule 42 and 43. So I think this is the most important notification we have to understand from the perspective of input tax credit. And there was some removal of difficulties which was introduced on the same day. Simultaneous to the notification, there was ROD also added immediately to clarify on ITC reversal for taxable area and exempted area. So here, whenever you are going to compute it, you have to compute based on the area base. So this is specifically, they brought it for removing the difficulties. So I think this is the way the notifications were introduced from 1/4/2019. Now the issue arises to all of us, what is the implication from 1/7/2019 to 31/3/2019? Is there any other notifications which will be applicable? So I think we have to understand that in notification 3/2019 itself, they have added the annexure 1 and annexure 2, which is clarifying the transitional input tax credit from the old regime to the new regime. I think that we'll see in the later, but we have to understand that lot of things they have made incorporated in the respective notification. So I think with this background, let us understand. And there was only one notification which was issued prior to this 2019, that is notification 4/2018, which was more or less speaking on the joint development agreement perspective and point of taxation perspective for JD agreement. So I think this was the notification. Otherwise, there was no specific notification for real estate industry and construction services. With this, let us understand the implication of input tax credit. Now, what were the rate of taxes which was brought as an amendment from the old scheme to the new scheme? I meant to say up to 31/3/2019, we have to understand this because it will help us out to arrive our input tax credit accordingly. So I will not stress much upon affordable housing. I will just go more with the non-affordable housing, because as you all aware, affordable housing is the one where the value should be less than, gross amount charged should be less than 45 lakhs. And the area specified for metropolitan city is 60 square meter. And for non-metropolitan, it is 90 square meter. So they have defined what is affordable housing. So there is a specific rate of taxes for this kind of affordable housing scheme, which is actually 1.5%. But if you take 1/3 as a land value, then the effective rate under the new scheme will be 1%. Whereas earlier, the rate of tax was 8% with ITC. Now in the new scheme, they have come out saying that it is 1% without ITC. Then other than affordable housing, whatever the other than construction services we are rendering, earlier the rate of taxes was 18%. So 1/3 went into land. So 12% effectively with ITC, we were levying the tax under old scheme, whereas under the new scheme, the rate of tax is 5% without ITC. So let us understand that new scheme, the new rates are coming out without ITC. Now let us understand that this we are talking for residential project. Now what is the impact for commercial project? So in the commercial project, they have specified the rate of taxes for REP and RREP. So they have just come out with a certain rate of taxes for REP. If it is a purely commercial project, then it will be 12% with ITC. And if it is a residential project, or then accordingly it will be 5% without ITC. So I think this we have to be understand the rate of taxes for REP and RREP. We'll just deal in the next slide what is REP and RREP. And for subcontractor also the rate of taxes are changed. For affordable, if the subcontractor is rendering the services to the main contractor, the rate of taxes was 18% for the subcontractor. Now, even though the after the new scheme, the rate of taxes for the subcontractor is changed from 18% to 12% subject to fulfillment of certain conditions. So for this, we have to look notification 3/2019 itself, where they have clarified the condition attached to levy the 12% tax by the subcontractor to the main contractor. This is only applicable for affordable housing. Please understand, I think many of us have confused that subcontractor should levy 12%. No, it is only for the subcontractor where they are rendering the services to a affordable housing developer. If it is other than affordable housing developer, then the subcontractor should charge a rate of taxes at 18% itself. So I think this is the way we have to understand the rate of taxes. In joint development agreement, I think though it is subject to a certain interpretation issues, but in simple terms, we used to understand that yes, in old scheme, developer was liable to pay and landowner was liable to pay in the case of JD agreement. Whereas now they have said yes, to the extent of constructed area transferred, yes, developer is liable to pay. But to the extent of development right transferred for the, they have said it is developer is liable to pay under RCM. So there is certain changes which has been brought under the new scheme from 1/4/2019. Now there are, before going into the aspects, we also has to understand as on 31/3/2019, what we are supposed to understand, which definitions we are supposed to look into that, and what is the implication of that. So first of all, we have to understand, is it that we are going to look for as a works contract service, or is it that specifically we have to look as a construction services? Please understand, the Rule 42 has referred only construction services. It has not referred anything for a works contract services. So I think we have to understand that construction services is a species of works contract, as we all are aware, and construction services as stated in second schedule as supply of services. So basically understanding that Rule 42 and Rule 43, whatever the mechanism they have specified only for the construction services, which has been specified in paragraph 5B of second schedule. So I think this way we have to understand that yes, only to that extent we are going to look into as a services for the current provision of Rule 42 and Rule 43. Now the most important is, if you look into the paragraph what has been added in construction services, they have said yes, construction of a complex, construction of a building, construction of a civil structure, or anything which is intended for sale to a buyer, but where the consideration is received prior to the receipt of completion certificate. So the most important aspect is, if you are going to receive the consideration prior to the receipt of completion certificate, it will be treated as supply of services. But if the entire consideration is received after the completion certificate or first possession, whichever is earlier, then it is not treated as supply of services. So I think this construction services has come out with a condition based that it should be a supply, and it should be, the transaction should take place prior to the receipt of your completion certificate or prior to the receipt of first possession. I think this first possession concept was not there under the earlier regime. Now they have brought it into newly under the GST regime. They have said either the first possession or completion certificate, whichever is earlier, that will be treated as your completed date project. That is treated as a completed date for the construction services, because till that point of time, it is deemed that you are providing the construction services. After that, it can be deemed as a supply of immovable property. So I think this concept we have to understand when we are reading a construction services. So the most important is, you have to also look into when is the completion certificate received or when is the first possession occurred, because this will relate with your input tax credit computations. Now next is whether, if you look block input tax credit, it purely says yes, if the works contract services are received for a construction of an immovable property, it is block. But you have to read further. Subject to that, if it is used for further works contract services, it is eligible. So as a construction services provider or as a developer, I am receiving a works contract service and I am also rendering works contract services to my recipient. So I am eligible for input tax credit. You should not say they have not stated construction services. It is stated as works contract. So construction is also forming part of your works contract. So that way we have to understand. And the second 17(5)(d) is talking on goods or services received for a construction of an immovable property on your own account, though it is used for your furtherance of your business. So especially like if you are constructing a property and then it is letting it out, basically this section is restricting the input tax credit, though it is subject to litigations before the Supreme Court as on date. So we have to wait for that decision, but as on date, it is eligible, but the section is restricting the input tax credit for that. So I think this is very important for us to understand. If you are going to talk it as an immovable property, for example, I'm doing a certain construction of project, whether I'm eligible for input tax credit. So if I'm constructing a project only for renting purpose, I'm not going to have any intention to sell that property. So can I call it as an blocked input tax credit, or should I take the eligible input tax credit? I think this is little interpretive issues on this, because Safari Retreat has already said that you are eligible, but it has gone to the higher authority. So I think I don't want to discuss much on that, but from the perspective of input tax credit, you have to factor it accordingly for this kind of block credit under 17(5)(c) and 17(5)(d). Now, the most important is project-based. In real estate industry, they have to maintain, they have to compute, they have to compute the input tax credit, they have to levy the taxes, is everything based on their project basis. If you have 10 projects, you have been given the option to go for the rate of taxes based on your project wise. The project is the one which is registered as a project with the RERA authority. So we have to understand that lot of definitions are borrowed from RERA Act actually. So we have to simultaneously learn the definitions of RERA, which has clarified certain definitions which has been used in the real estate notifications. So they have said, what is project? Project is a real estate project or residential real estate project. So what is real estate project? What is residential real estate project? I think we have to, before going further, we have to clearly understand what is real estate project and residential real estate project. So before going into real estate project, let me tell you what is residential real estate project. Residential real estate project is also a real estate project in which the carpet area of commercial apartment should not be more than 15% of your total carpet area. For example, if Godrej is constructing apartments, say they are constructing, simultaneously they are coming out with a small mall beside that apartment, or they are coming out with a small commercial complex in that. But if the total share of that carpet area of that commercial complex is less than 15% of the total carpet area, then still it will be called as RREP. That is, still it will be called as residential real estate project. So the most important is, if the commercial area, if the commercial carpet area is more than 15%, then it will be called as real estate project. But if it is less than 15%, then it will be called as residential real estate project. So very, very important for us, because in future slides, I will be only talking on REP and RREP. So please make it very clear. RREP is the one where the commercial share is less than 15% of total area, and REP is the one where the commercial share, that is commercial carpet area, is more than 15% of your total carpet area of that project. So this is the one difference between REP and RREP. Then they also has defined what is residential apartment and commercial apartment. So if you have to treat as an apartment as a residential apartment, you have to call it as an apartment which is meant for residential use, and it should be notified by RERA also that yes, it is a residential apartment. And what is commercial apartment? Commercial apartment is the one which is other than the residential apartment. So this is the way the terminologies we have to understand. And then the most important is, what is ongoing project? Ongoing is nothing but it is in work in progress. It's still on a running basis. It is not yet completed. So in that case, what they are saying is, what are the conditions to be fulfilled to treat it as an ongoing project? Why this is important? Before looking into the conditions, we have to understand that this is very important, because only if you are an ongoing project, you have the option to go for new rate of tax. You have a choice to go for new rate of taxes or old rate of taxes. If you're not an ongoing projects, you don't have the option for going the new rate of taxes or old rate of taxes. If we are not fulfilling the conditions of ongoing project, you will be deemed to follow the new rate of taxes, because after 1/4/2019, any project you are going to commence, there is no option for 12%. You have to go for 5% rate of taxes without input tax credit. So the government want to very clearly bring out, the law wants to bring out a clarity that you can treat a project as an ongoing project only if all these conditions are fulfilled. Please understand, all the conditions should be fulfilled. It is not something partly, all full conditions should be fulfilled. First is commencement certificate should be issued before March 31st, 2019. This is very important. And the next is, if certificate should be received from architect, chartered engineer or surveyor if that project has been commenced. Wherever the commencement certificate is given by the government authority, that you can consider. If that is not issued, if that is not received, then you can also obtain a certificate from architect or chartered engineer or licensed surveyor that project has commenced. Even that will suffice as a condition. Next is completion certificate or first occupation should not be issued before March 31st, 2019. Because if it is already issued before March 31st, 2019, then you cannot treat that project as an ongoing project. And the next condition is that apartments are partly or wholly booked before March 31st, 2019. It is not that you have just commenced the project. You should also see that you would have booked certain apartments, either one apartment or whatever it is. Apartment should be partly or wholly booked before March 31st, 2019. So these all four conditions are required to be fulfilled to treat it as an ongoing project. Why I brought this? Because if you are an ongoing project, you have the option to go for old rate of taxes or new rate of taxes. Why I wrote here apartment booked before March 31st. What do you mean by apartment booked before March 31st, 2019? So even that is also defined in the notifications. What is that? They are saying time of supply for part of construction prior to 31/3/2019. That is, you can call it as an apartment which is booked prior to 31/3/2019 only if the time of supply has occurred prior to 31/3/2019, or at least one installment you would have credited to your bank account, and there is some sale agreement which has been entered prior to 31/3/2019. So if these conditions are fulfilled, then only you can call it as an apartment booked prior to 31/3/2019. So I think this is very, very important to understand ongoing project. Along with the ongoing project, we also have to read apartment booked on or before 31/3/2019. These all conditions are important to treat that project as an ongoing project. Now next is carpet area. Why I have specifically written here as carpet area? Because carpet area plays very, very important role. In the GST law, they have not referred built up area. They have not looked into saleable area, super built up area, nothing. They have just said carpet area as defined under the RERA Act. So whatever is defined in RERA Act, the same definition of carpet area will be applicable for this notification. So for any computations of our input tax credit, we have to rely only on carpet area. Specifically, they have used the word carpet area in all the rules and notification. So we have to be very careful whenever we are doing a computations of our taxes and input tax credit. Now the next is project which commences on or after 1/4/2019. What do you mean by this? So even they have defined, what do you mean by project which is commencing after 1/4/2019? They said, okay, any project other than ongoing project, it will become as a project after 1/4/2019. So the most important is, if the project is not fulfilling all the condition of ongoing project, they are deemed that they have to follow the new rate of taxes of 5%. So this is quite important. We have to look into that. Please understand, on 1/4/2019, you should also see that if there is a change in the rate of taxes, you should also look into the time of supply, whether new rate of taxes will be applicable or old rate of taxes will be applicable for certain type of transactions. Because earlier the rate of taxes was 12%. Now the rate of taxes is 5%. So please, as on 1/4/2019, whenever you are going to do the analyzing, please look this time of supply prior to 31/3/2019, because this will also play important role to arrive the input tax credit pertaining to the transactions where the time of supply has occurred prior to 31/3/2019 and post to 1/4/2019. Because if the time of supply has occurred prior to 31/3/2019, you will be enjoying the credit. But if the time of supply has happened post to 1/4/2019, then you may not be enjoying the input tax credit as on 31/3/2019. So we have to be very careful to understand the arrive the time of supply on 31/3/2019. So to arrive those event, you should look what is the due date for completion of a milestone, when is the money received, or when is the invoice raised. The transition period, you have to be very careful. Accordingly, your input tax credit mechanism will be playing an important role to decide a eligibility and reversal of input tax credit whenever the transaction is having a time of supply. The most important is during 2019, you have to see as on 1/4/2019 for any activity, whether TOS is prior to 31/3/2019 or time of supply for that transaction is after 1/4/2019. So we have to look into this to arrive our input tax credit as on 1/4/2019. Whenever you are looking for change in the rate of taxes from old rate to the new rate of taxes. So effectively, let us understand the rate of taxes. I will not discuss on affordable. I'll just discuss on non-affordable. So if it is RREP is residential. So the rate of tax is 5%. We are clear, new rate of taxes. If it is RREP, I'm writing commercial, but still I'm saying 5%. Why? Because the share of commercial area is less than 15%. So it is deemed that it is kind of residential project only. So based on that, they have said it is 5%. Please understand this, because this is the most important chart for us to arrive the input tax credit now. So if it is RREP commercial also, still it is 5%. If it is REP residential, that is real estate project, if it is a residential project, it is 5%. But if it is a real estate project, which is commercial project, then it will be 12%. So I think this we have to look into that, whether it is a commercial project, purely it is a commercial project, or whether it is a residential project attached with the commercial. So I think this way we have to understand RREP and REP. Yes. So please understand the implication of this. Now, before going into that, I thought just I'll spend some 5 minutes for what actually basically many a times when we are doing this analyzing of taxes and computation of input tax credit, we are not able to track the documentations. What are the source of documents from where you have to pick the informations for computations of your input tax credit? So to the extent whatever I can add up the documentations, I have added for the benefit of members, so that whenever you are going to compute your input tax credit for this, after this change in the rate of taxes, you have to kindly look into this documentations also to extract the informations and to arrive the computations of taxes as specified in the notifications and rules. So I think you all are aware, these are the type of agreements which we look into, like JD agreement, sale agreement, all this contractors agreement. This all the type of agreement. I think we have to just concentrate on that. Then nextly, we also have to look certificate also, because this certificate will help us to decide whether there is a completion of project, whether there is a commencement of project, whether this project is sanctioned, whether we have to obtain the chartered accountant certificate in certain issues, like they have specified in 1 or 2 scenarios where your procurement is more than your consumptions to arrive the input tax credit. They said, yes, you have to obtain a chartered accountant certificate or cost accountant certificate to arrive this input tax credit as on 31/3/2019. So I think this all, whether it is RERA registered, it has to be RERA registered, then only it can be called as a project. So you should obtain these documents to understand that, is it a RREP, is it a REP, what is registered under the RERA Act, what are the information furnished for RERA, what is a carpet area which has been furnished to the RERA authority. I think this will help us out to extract the data and compute the input tax credit, compute the taxation for GST law also. Then data analytics also is required to certain extent, because this will help us out to understand what is the percentage of completion which has taken place on 31/3/2019, because this will help us out to decide what will be your input tax credit, which is going to get eligible as on 31/3/2019, depending upon your completion of your project, or depending upon your invoice raised, or depending upon your consideration received. So there are a lot of factors which you have to look into when you are computing your input tax credit as on 31/3/2019. So we have to look even this, what is the completion percentage which has been arrived on 31/3/2019, and you have to compare what has been declared to the RERA authority also simultaneously to understand. And then we have to also understand what are how many apartments are there, how many apartments are booked, what is the carpet area of residential apartment, what is the carpet area of your commercial apartments. I think these are the pre-informations which are required for us to compute the taxation and input tax credit. Then what is the transitional credit which has occurred on 31/3/2019? I think this is the most important area for all of us actually to look into that whenever, especially you are going to do the audit of 18/19, and accordingly, please look into the, especially if we are handling real estate, please re-look into the impact of this transitional credit if they have opted for new rate of taxes. Then time of supply, we have already discussed installment, allotment letter. I think this is fine for you. Then liability payment also, I think this is, you all are well versed with this credit ledger and all. There are certain self-declaration which we have to make. The law has not specified. I think these are the declarations which we have to keep it ready whenever we are going to compute, whenever we are going to assess the input tax credit. When is the first possession declaration? Why I said first possession? You only have to self-assess. There is no competent authority which will determine that it is a first possession. For completion certificate, we have a competent authority, but for first possession, we don't have any competent authority. So we only have to self-assess and take a declarations to compute our input tax credit. Why? Because as on that, I have already told you, it will be the date of completion or date of first possession, whichever is earlier. That will be your completion date. So this first possession declaration, I think we have to take a self-declaration. Then declaration by the developer that value of this affordable housing is 45 lakhs. What are the invoices issued between 1st April to 10th May? Why this is required? Because on 10th May, you are supposed to give a declaration to the government that, yes, I will continue with the old rate of taxes. So I think you have to look into the invoices issued during that period. And also you should say, yes, this project, I'm considering it as a real estate project, or this project, I'm looking it as a RREP project. So these are the certain prerequisite informations which will be, which have to be analyzed before working upon the data of input tax credit. So I'll not go much with this. I think you can just go through this. This will be shared with the members. So that way you can look into that. Now let us come to the topic of input tax credits. I think before that, I just want to bring one more information. This project-wise inward supplies of registered person, that's data collections, whatever we are talking here, project-wise inward supplies of registered purchase and unregistered purchase. So if you have opted for new rate of taxes, we also has to, or you are under the new rate of taxes, we have to maintain a separate documentation for project-wise, whatever the inward supplies of registered purchase and unregistered purchase. Why this is required? Because you have to compute every month whether you are making a purchase of more than 80% of registered purchase or not. Because at the end of the year, again by June of this month, you also have to compute on a yearly basis whether overall the condition of 80% from registered purchase is fulfilled or not. Why this is required? Because I already told you, if you have to opt for the new rate of taxes, you have to fulfill certain conditions. So first condition was input tax credit is not eligible. Second condition is that 80% of your purchases should be from registered supplier. So I think this way the bifurcation is required to maintain a detailed books of accounts. So accordingly, you can compute your input tax credit. If it is less, then it will become your liability. So I think this is important info. We are waiting for the annexure, which is not yet notified, which was supposed to be notified and which was supposed to be given by the June of this month, which is specified in notification 3/19. But as on date, I'm not able to see in the portal that they have notified any such annexure to compute the more than this under 80% registered purchases. So I think this we have to wait and just see what we can do on that actually. So capital goods also we have to maintain separately, and input services, we have to maintain the separate inward registers. I think this is the basic documents we are looking. Now the most important, now let us come to the topic what we are going to discuss in detail. This is a topic of input tax credit. I think if we understand, many times we should not look only with the rate of taxes. We should also see the impact of our input tax credit, whether it is going to be adding to your cost or whether it is a beneficial, whether it is eligible, whether it is ineligible, because ultimately if it is not eligible, it becomes a cost. It becomes a cost of construction. So ultimately any planning we are going to make with the new rate of taxes or any rate of taxes or any implications we are going to look, we also have to see what is the cost factor involved in our input tax credit. So I think this is the most important, because this is affecting a cascading tax effects, because ultimately this it is believed that it is ultimately sold to the final consumer, and anyway they are not eligible for input tax credit. So I think based on that they said yes, you charge at the concessional rate of taxes, but as a construction service provider or as a developer, I have to understand what will be my input tax credit which will be eligible, what is the input tax credit which will become as an ineligible, and to what extent I should factor it as my cost. So this is very important, play very important role whenever you are budgeting for your real estate projects. So this is, I thought I'll just bring out on this ITC aspects also. So if we look input tax credit, especially for construction industry, nothing, we are going to apply the regular sections, regular provisions, that is 17(1), which is directly dealing, yes, this is based on your self-assessment basis. So whatever the credit is eligible, you decide on your self-assessment to what extent you have used it for your business purpose, to what extent you have used it for non-business purpose. So I think, for example, if I'm, say I'm a developer, I have procured say 100 AC, out of that 10 ACs I have shifted to a managing director's house, or I've shifted to an employee's house. So should I call it as a non-business or should I call it as a business? I think here it plays role. But if it is something beyond the business, if you are doing anything as such, to that extent, input tax credit should be disallowed under 17(1). And the concept of non-business purpose has been brought only under the GST law. This was not there under the erstwhile law, specifically in the VAT law, but in the GST law specifically, they brought, yes, on your self-assessment basis, you decide to what extent of your input tax credit is used for your non-business purpose. That is specified in 17(1). Then apportion your input tax credit, whatever the credit you are having, you decide what is your taxable activity, what is your exempted activity, and accordingly you restrict your input tax credit to the extent of exempt supply. So I think this is basic provisions which we are applying, and accordingly we'll take it further. 17(3), especially if you see the specifically, they have defined exempt supply, and they said for the purpose of input tax credit apportionment, exempt supply also include sale of land. Exempt supply also includes sale of completed building. So whether this exempt supply, whatever they have specified, whether whatever the value of land I'm going to collect from my buyer, should I treat it as a sale of land and should I reverse my input tax credit? Or should I say, no, there is no question of exempt supply, because this is talking purely of sale of land. This is not talking of supply of land. So I think that is the interpretations which is going on. And on supply of land, whether to be treated as an exempt supply and reverse the input tax credit, there is no clarity as on it. But it is a different, it is my belief that we can consider it accordingly and reverse the input tax credit if there are certain expense which you can say that yes, it is used for the land as well as for the building also, like post marketing expenditure. There are certain expenditure which you can correlate with the supply of land and supply of construction services, and accordingly you can decide for apportionment of your input tax credit and treat it as a exempt supply. Now coming to a rule of, specifically rule 42 and rule 43 has come out with a mechanism to decide on a availment of input tax credit and reverse the input tax credit. So very, very important is rule 42 and rule 43. Rule 42 is specifically talking only on input and input services. Rule 43 is coming on capital goods. Why there is a separate rule for capital goods? Why not it has been brought under the input and input services? Because there is a difference in input and input services and capital goods. Because the definition of capital goods itself says that capital goods are the one which is capitalized in the books of accounts. And for GST purposes, the life of capital goods is 5 years from the date of purchase of capital goods, from the date of invoice of capital goods. But for input and input services, there is no such life has been specified. That's why there is a separate mechanism specified for capital goods, treating it as a life of 5 years. And if that capital goods is used for both taxable goods and exempted supplies, then you are going to reverse the input tax credit to the extent of exempt supply. Very, very tedious task, I will tell you, especially for capital goods. So I think we have to first understand the formula, but very interesting, I will tell you. I have added lot of simple illustrations in my further slides to make you understand, because the most important objective of today's session is I want you to make you understand what is the reading of Rule 42 and Rule 43. I'm not going to interpret on Rule 42, 43. I'm only going to read and make you understand whatever I have understood to the extent of as drafted in Rule 42 and 43 with the simple illustrations. The next is common provisions. I think along with these common provisions, there are special provisions which are brought for the real estate. It doesn't mean that only the provisions specifically for real estate they are brought in. No, along with the common provisions, we also have to apply special provisions to compute your input tax credit eligibility and reversal of input tax credit. I think this is most important for construction industry. Common provisions, I think most of you are aware because it is already 2 to 3 years. We already would have computed the input tax credit, but just for the simple understanding, we have to just understand how we compute a input tax credit in Rule 42. So in Rule 42, out of your total input tax credit, whether it's a total basket of your credit, you have to pick out what is your input tax credit, which is used for your non-business purpose. That is termed as T1 for Rule 42. Please don't get confused with that. It is a simple basis. Out of your total basket of your credit, just exclude the credit which is used for non-business purpose. Then out of the balance credit, remove the credit which you say that yes, it is purely used for your exempted supply. That also called as T2. Then you have something called as block credit. In 17 subsection 5, they have specified what are the credits which are blocked. So that will be called as T3. So this T1, T2, T3 is the credit which you have to remove from your total basket of your credit to arrive your common credit. Yes. And what is T4? T4 is saying that if you are using purely for taxable supply, you can call it as a T4. This is I'm calling as a common provisions. But for real estate, T4 will be different. Please understand this. Whatever I'm saying is it is only for the regular provisions. So after removing that credit, you have something called as T2 is nothing, C2 is nothing but your common credit. You cannot decide, you doesn't know how much credit is used for exempted supply, how much credit is used for your taxable supply. All those credit will sit in your common credit. This is a common provisions. So you have to arrive E and F, whatever I'm stating here, that is nothing but out of your common credit, you have to apportion how much is for exempted supply and how much is for a taxable supply. And D2 is nothing but 5% of C2. This has come because you have to identify the common credit to the extent of non-business purpose. So this is the common provision. Now for real estate, what we are supposed to do? For real estate also, same thing you do. T1 you do, T2 we have to do, T3 we have to do. But T4 will be 0. How can be T4 will be 0? I think that we will see in our next slide now. T4 will be 0 for the construction industries because it cannot be arrived depending upon the type of project we have to look. How can you arrive as on date? Because the duration of the project can be 3 years, 4 years. I doesn't know how many flats are going to get booked. Only to the extent the flats are going to get booked, to that extent you are going to call it as a taxable supply. So to the extent that flats are booked, you will only come to know at the point of your completion certificate. That's why for real estate, for construction services, T4 will be 0 because everything credit, whatever you are having, that will be called as a common credit. Whereas in your regular provision, you will have a credit which you can say, yes, to this extent credit I have used for my taxable supplies. Whereas for real estate industry, please understand T4 will always be 0. So this is a basic difference I want to make you understand between common provision and the special provisions. For real estate, T4 is 0. Now, most important is there is a separate mechanism they have specified for reversal of credit for construction of apartment. In future slide, I'll just tell you how we have to compute the reversal of your input tax credit. Whether reversal has to be done monthly or on final basis. This is the most important aspect of our Rule 42 and 43. Please understand the reversal when it is supposed to be done is more important. It depends upon which rate of taxes you are opting. If you are opting for the old rate of taxes. You are still under the old rate of taxes. You forget that there is a new rate of taxes. You are still under the rate of taxes. You doesn't know when it is going, when you will only come to know how much flats are sold and how much flats are unsold only on the date of completion certificate. So in that month, that month in which you are receiving a completion certificate, that month you are supposed to compute your reversal of input tax credit. Then what is this final? The law has stated, okay, you compute in the month in which you are receiving a completion certificate based on the credit which is there in that month only. Then what is final then? They said final you are going to compute for the whole project. Take out the whole credit. See how much flats are sold. For example, if it is a 1 lakh credit and if you have sold only 10 flats, then I think you have to restrict your input tax credit for 90 flats. So finally you have to arrive, because this cannot be arrived monthly. It has to be arrived for the whole project. So can it happen in a month wise? No, the law has stated, no, you have sufficient time to compute a project wise. So they have said, yes, if it is pertaining to 1920, you have the time till September 2020 to compute for the whole project. If your project is completed in 1920, please remember that we have the time till September 2020 to compute the input tax credit for the whole project. So this is very important. Reversal either monthly or finally will be deciding depending upon the type of project, depending upon the type of rate of taxes we are opting into that. So we have to be very clear. It's very simple. Only thing is we have to just understand. Logically, we have to understand, yes, this is right. This may not be monthly. This may not be finally. So I think this is the way we have to understand. We'll see in our next slides. Then reversal should be based on our carpet area. We have already discussed on that. It should not be on your value of apartments. It should be based on your carpet area. The next is credit used for taxable service should always be 0. I think we have discussed T4 will always be 0 for construction industry. And please remember, value of exempt supply and taxable supply should be computed project wise and tax wise. So for separately for CGST, separately for SGST, and separately for IGST has to be computed. And each project wise you have to compute rule 42 and 43. It is not like overall we used to take under the erstwhile law. It is each project wise we have to compute depending upon the type of project and rate of tax opted. Then the next very important is interest computations. So why I wrote like relief from interest is available. So I think if you remember, we get a relief from interest. Why? Because in a regular proceedings, the law said that within 1 year, you have to recompute your yearly computations. Whereas for real estate, they said, no, you have to compute your final computation only in the year in which you have received a completion certificate. So I think to that extent, we will save the interest. So even though your project is 5 years, you enjoy the credit for 5 years. At the end of the 5 year, whenever you are going to receive your completion certificate, at that point of time, you compute your reversal of your input tax credit. After that, in the next September of that year, you have the time to compute the reversal of input tax credit. Only they said from April to September. Otherwise, in the regular provision, what was happening? Every year we were supposed to pay the interest. Whereas here they said only the interest will be computed from 1st April, only based on project wise. It is not like 5 years project, 5 years interest will be there. Interest will be there only for the next 6 months if it is computed in the year. Say for example, 1920, my project is completed in say May 2019. So I am given the time to compute the reversal of input tax credit till September 2020. So if I'm not completing the, if I'm not doing that computation of reversal of input tax credit, then I will be liable to pay the interest. But what the law has stated, the interest will be leviable only from 1st April 2020 to 30th September 2020. You need not calculate for 19, 18, 17, nothing. You are only required to calculate reversal of input tax credit interest for 1st April 2019, 20 to September 2020. Say your project would have commenced in August 2017. So you did not compute the interest for every year. You compute the interest only for this 6 months if you are going to compute your reversal of input tax credit by September. I think this is the relief we are getting from interest. Otherwise, 5 years project, 5 years interest. You have already enjoyed the credit for 5 years, but still you need not pay the interest. So this is the best concession we have. And please remember, this concession is only for D1 and D2, and it is not for T1, T2, and T3. So I think T1 is non-business, T2 is exempt supply, and T3 is block credit. For that interest relief is not there. Interest relief is there only for D1 and D2. So I think this is one of the point I thought I'll bring out to the members. So these are the 4 type of projects I think which we have to analyze to reverse your input tax credit. Because if you see the rules, if you see the computations, if you see the annexures, we get with multiple options actually. But depending upon, first of all, you have to test which project is it. Is it an ongoing project or is it a new project? New project, no option. You are going with the new rate of taxes. So no question of credit. If it is an ongoing project, I have written RREP ongoing project. It should be first of all residential real estate project. It should be ongoing project. And you have said, I am opting for old rate itself. So when you're opting for old rate, let us see how to compute the input tax credit. For first option, I think you will take little time. But once you understand this option, I think it is easy for you to understand the other options for your reversal of input tax credit. Say, for example, if you are under RREP, what I said, RREP is residential real estate project where you are going for old rate. So you have forgotten that there is something new rate of taxes. So for you, it doesn't make difference. What they said, okay, you file annexure 4 to the government. Yes, we filed it. I am enjoying the credit. I am eligible for credit. Yes. But when I'm going to reverse the credit? Only at the time of completion certificate. Why? Because I don't have anything as exempt supply until I receive a completion certificate. I will have exempt supply only after completion certificate. What will be that exempt supply? That exempt supply will be nothing but my unsold flats. So to the extent of sold flats, it will be taxable supply. To the extent of unsold flats, it will be exempt supply. So till that date, I don't know what will be my exempt supply. So I need not make any reversal in any of the month to reverse under Rule 42. I will be enjoying the credit because I'm under the old rate. I am charging regular at 12%. I'm enjoying the credit. I am going to reverse the credit only in the month in which I'm going to receive a occupation certificate or completion certificate. So very, very important. You are going to receive only in the completion certificate. Till that you enjoy the credit. Enjoy the credit in the sense you can avail that credit in your returns. Illustrations. For example, say ITC is 10 lakhs. I'm enjoying the old scheme. I am not looking into anything as new rate. And I received in the month of December 2019, I received a completion certificate also. So in that case, what they're saying, to the extent of unsold, it becomes an exempt supply. So to the extent of unsold, it is 40,000 carpet area. So your input tax credit is 10 lakhs. So 10 lakhs into 40%. So because if you see flats unsold is nothing but exempt supply. So 10 lakhs into 40%, that is 40,000 divided by 1 lakh. So to the extent of 4 lakh, we are supposed to reverse the input tax credit. I think you're clear on this because it is nothing but whatever the total input tax credit you are having, common input tax credit you are having, whatever we are going to look this ITC, it is nothing but common input tax credit, not the whole input tax credit. We have to first arrive our common input tax credit. On that, first arrive on the date of completion certificate. What is my exempt supply? What is that exempt supply? On that date, you calculate what is the carpet area of your sold flats, what is the carpet area of unsold flats. To the extent of unsold flat, we have to reverse the input tax credit of 4 lakhs. Final reversal, already I told you, okay, you do in the month in which you have received the completion certificate. Along with that, for the whole project, you have the time till September 2020 for the year 1920. You have the time till September 2020 to compute the input tax credit. Now the issue is, when you are going to calculate for this total formula, you have to don't take all earlier credits. Take the credit from your July 1st, 2017, whatever is credit available in your GST, only to that extent you are supposed to take a input tax credit for calculation of your final formula. So if in case if you have transition credit also, for that also you can you have to take it separately. But for calculating Rule 42, if that transitional credit has been taken it as your GST credit, then even that should also be considered for your computation of your input tax credit to arrive your unsold and sold part. So I think this is quite simple. To the extent of unsold, it's an old rate, no change in the rate of taxes. I'm enjoying the input tax credit only on the date of completion certificate. I arrive my exempt supply and I reverse the input tax credit to the extent of unsold flats of my carpet area. So this is for the whole project. So one example of that. Say I begin my project on 1st July 2017. So my input tax common credit was 1 crore. So out of that, I think flat sold and unsold, we are clear. So unsold is 40,000. So out of 1 crore, 40% is reversed. So already we have reversed 4 lakh here. The month in which we have received the completion certificate, we have already reversed the 4 lakhs. So whenever you are going to do the whole computation of the project, you should also reduce from the 40 lakhs. You also have to reduce the input tax credit, which is already reversed in the month in which you have received the completion certificate. So out of 40 lakhs, 4 lakhs is already reversed. So balance 30 lakhs, 36 lakhs, you are supposed to reverse on by September 2020 for the year 1920. Subject to that, completion certificate or first possession should happen in 2019-20, and you have opted for old rate of taxes. Yes, so this is for Rule 42, input and input services. Now next is capital goods. This may take little time, just 5 minutes. I want members to analyze it. It is quite simple, only the mechanism is quite different. Here also they say, yes, there is no monthly reversal. You arrive the reversal at the time of completion of your certificate. So in case if you are receiving the, say, total carpet area is 1 lakh, out of that 75 and 25, whatever to the extent of unsold carpet area, we are reversing in the month in which we are receiving a occupation certificate. Now the question is how to arrive at the final computations, because as already I've told you, for capital goods, the life of capital goods is 5 years. So on the date of completion, the capital goods would have been used for only part of the year, like 2 years, 3 years, 4 years. So it might be above 5 years. So above 5 years, no question. But if it is used for below 5 years, say 2 years or 3 years, we are supposed to reverse the input tax credit for the balance period, because on the date of completion date, it will amount to a exempt supply. So once it amounts to an exempt supply, we are supposed to reverse the input tax credit pertaining to a capital goods, because for GST law, the credit is distributed in 60 months. And in any month, if you are using that capital goods for exempt supply, you are supposed to reverse the input tax credit for the balance month. So please remember, here for reversal, we have to do each capital goods wise. It is not like overall we have to take. We have to compute the capital goods mechanism for each capital goods and take the date of invoice of that purchase of capital goods and arrive the number of months as on date of completion certificate. Very, very important for capital goods. I think additional exercise is required for capital goods. Now, this is a quite interesting formula. So actually I was thinking whether to add it or not, but something made me to add this, because this is quite interesting to arrive. How to arrive the capital goods which has been used on the completion certificate. So as on, if I'm under the old rate, yes, I'm enjoying the credit. As on the date of completion certificate, how much flats were unsold? So the unsold flats are, say, 25,000 square feet. So to that extent, I should reverse my input tax credit. And what is this E1, E2, E3, all this? Why? What is this formula they are talking? This formula we are going to use in our next option, but we have to first understand what is the concept of this formula. Basically, conceptually, the law is looking that, okay, whatever you are enjoying the input tax credit, pertaining to your exempt supply, these reverse the input tax credit. Now, what is E1, E2, E3? Because we have only one exempt supply. What is that one exempt supply? Which is unsold. Only to that extent I am having a exempt supply. Then what is this E1 and E2? E1 is talking, okay, if you have decided that, yes, this is an exempt, because there might be certain project where you said that, yes, it is used for new rate of taxes, then to that extent it will become as an exempt supply. Please remember, if you are going with the new rate of taxes, for example, I am having a project where I'm opting for new rate of taxes. Forget this. I'm opting for new rate of taxes. That new rate of taxes flat will become for me as an exempt supply. That's why they have added E1. E1 is nothing but the apartment for which you have opted for new rate of taxes, that is called as E1. It is not applicable for this option, but I'm just saying what is the formula meant here. E1 is for the supply of apartment for which new rate of taxes has been opted. What is E2? E2 is nothing but as on 1/4/2019, there was a change in the rate of taxes. So because of change in the rate of taxes, there is a input tax credit partly which was allowable prior to 31/3/2019, and there was certain input tax credit which was ineligible after 1/4/2019. So for this computation, they have come out with E2. So the most important is E1, E2, and E3. But for this option of RREP with old rate of taxes, you will be applying only E3. E3 is nothing but unsold flats. So to the extent of unsold flats, we are having as a 25,000 square feet of unsold flats out of 1 lakh. So you are going to reverse out of your 5 lakh credit. You are going to reverse the input tax credit to the extent of unsold flats, and balance you will be enjoying the input tax credit. So this is the concept for capital goods under Rule 43. I think I'm clear on this. If anybody wants to ask on this, because the more or less the same kind of formulas will be there in the future slides with the certain changes, but this is the concept we have to understand for reversal of input tax credit. Here we are taking E3 because we are still under the old scheme. We have not opted for new scheme. So E2 is not a question for us. E1 is not applicable. Only E3 we are going to calculate to the extent of flats unsold as on 31/3/2000. Sorry, as on the date of occupation certificate or completion certificate. This was the first option. I think a pause is required because RREP we have done with the old. Yes, sir. Hello. I'll just finish this. Then we can just discuss, because I just want to make you understand what is a methodology we have to apply depending upon the rate of taxes and depending upon the project we are going to look into that actually. Now we are coming to a next type of project. What is that? Real estate project. Earlier we have seen residential real estate project. Now we are seeing real estate project. In this real estate project also, the carpet area of commercial apartment is more than 15% of your total carpet area. So here what we have to do is, here also the same methodology. I'm still under the old regime. I'm charging a same rate of taxes for my residential apartment, that is 12%. For commercial apartment also, I don't have any concession. So I'm charging the regular rate of taxes. So I can enjoy the credit for residential apartment also. I can enjoy the credit for my commercial apartment also. So I need not do any monthly reversals, because as on date, I am not able to arrive my exempt supply. I know it will be arrived only at the time on which the completion certificate is issued. That is what Rule 42 sub Rule 1 is saying. Reversal in month in which CC is obtained. You reverse only in that month. Till that time you enjoy, you set off with your liabilities. Only at that point of time you will come to know what is the input tax credit which has to be reversed. More or less like RREP project only, not much changes. Only in this you will have commercial apartments separately, whereas in RREP project it will be purely residential apartments. So same example, I think we are more or less understood. Here we have to consider unsold flats of not only residential, you also have to consider unsold flats of your commercial flats also to compute the reversal of input tax credit in case of REP projects. So same thing like final reversal we have to do. One is the reversal you have to do in the month in which you are receiving completion certificate. The other reversal you have to do by the end of the September. So here I have stated as before September 2020 because I am taking the completion date as December 2019. So accordingly, I will be reversing the input tax credit for the, I will be recomputing the input tax credit for the whole project to the extent of sold flats and unsold flats, and I will be recomputing for the whole project. Yes. So this is again the example. Please remember, it is more, everything is same like RREP. Only thing is I'm just adding the commercial apartments here to make you understand that REP project includes even the commercial flats also. So it's like same thing for capital goods also, no monthly reversal. The reversal will be made only at the time of receipt of your completion certificate. And please see that credit on monthly basis will have to be reversed depending upon the proportion of capital area. So the month in which you have received the occupation and completion certificate, you have to be very careful in computing the input tax credit in that month, because you should take the credit only pertaining to that month. Don't take all earlier period and compute it. You only arrive the credit what is there in your credit ledger in that month, and out of that you arrive, okay, in this month what is my unsold, what is my sold flats. Only for that month credit, that month common credit, you reverse to that extent and show it in your form 3B. So don't take last 10 months, 12 months, 1 year. Don't take all that. That whole project recomputations has to be done in a overall basis, and it has to be separately computed and furnished by next September. But as on that date, if you're able to do for the whole project also, then also I think you can recompute it accordingly. There is no bar on that. But here they are, Rule 43(1)G is specifically clarifying on the credit which is available in that respective month in which you are receiving a completion certificate or first possession. So this is separately we have to compute it. And then again we have to do a final reversal, that is under 43(2). Same way it is old scheme only. Here also we have only E3. We don't have E1 and E2. Why? Because E1 and E2 is applicable only when you are going for new rate of taxes. Here we have to reverse the capital goods credit to the extent of unsold flats, that is E3. So that has to be computed. Otherwise E1, E2 will be 0. I've stated already here, E1, E2 will be 0. It will be E3 to the extent of unsold flats, that is whether it is residential or commercial, all has to be added, and to that extent you have to reverse your input tax credit. Yes. So I think we have done the easy part actually, the most easy part of our Rule 42 and 43. So before going into the next slide, I just want to summarize in brief that this project is either it can be real estate project or it can be residential real estate project. It is opting for the old rate. It is not at all opted for any new rate of taxes. So for this kind of projects, don't do any monthly reversal. You are supposed to do the reversal only at the time of receipt of your completion certificate. So one kind of reversal you are supposed to do in the month in which you are receiving a completion certificate, and one more complete project reversal you are supposed to do by the end of the September of the next financial year. So you have a time to till next year to recompute for the whole project, and accordingly you can reverse the input tax credit. And if there is no credit as such, then you are required to make a payment of taxes if you have enjoyed the excess credit. But if you have enjoyed the less credit, then you can enjoy the balance credit, which is even you are enjoying after CC also. If you have certain credit which you have to enjoy, that you can enjoy it. So there is a mechanism which they have specified that if you are enjoying the excess credit, you have to reverse it. If you are not enjoying the credit which was supposed to be enjoyed, then you can take that credit in your form 3B. So I think this computations plays very, very important role to compute the reversal of input tax credit. And accordingly, if you don't have anything as such, you are liable to make a payment of these taxes through DRC3. So very important, you have to be very careful whenever we are enjoying the credit. Do this analyzing yearly or quarterly, so that you get to know like based on the year how many flats are sold and what is the possibility of input tax credit reversal. So I think this will help you out, because at a time if you are going to do for the whole project, there is a possibility that you would have enjoyed the most credit, and now there is a possibility that you will end up paying taxes. So this has to be really looked into, that depending upon the number of flats sold and unsold. Though the law is requiring you to compute on project basis, but it is internally analyzing is better you look into that every year, so that you get an idea to what extent tomorrow the input tax credit is going to get reversed. So this is quite simple. Based on the unsold flats, unsold flats is treated as an exempted supply, and we are reversing the input tax credit. Now the most important is RREP project. What is that? Residential real estate project. I want to opt for new rate of taxes on 1/4/2019. So as we have already discussed, the new rate of taxes on 1/4/2019 is 1% for affordable housing and 5% for non-affordable housing. So the rate of tax is 5%. Let us presume it is only, we are talking only for non-affordable, so it is 5%. Now, how to compute the input tax credit? Because I am eligible for input tax credit up to 31/3/2019. I'm not eligible for input tax credit from 1/4/2019. So how I should compute my transitional input tax credit? That is very, very important, because there is a possibility that you would have enjoyed the excess credit. There is a possibility that you don't have enjoyed the credit to the extent you were eligible for credit as on 31/3/2019. So for this, I think we have to look into the annexure 2, very, very important, which is specified in 3/19. I request the members go through to that annexure 2 of 3/2019, which has come out with an illustration, very simple illustration. I'll just give you in brief what is that illustration is stating. Then I think you can look into the computation part. This illustration has analyzed lot of analytical tool. The tool is, because as on 31/3/2019, there are various probabilities which could have happened. What are various probabilities? Possibly there is something, the project is completed. Yes, there is certain project which would have been completed by that date, but invoice wouldn't have been raised. Or there is a possibility that the invoices have raised, but the construction has not yet begun. Or there is a possibility that you have received the advances from the customers, but you have not commenced the project. So once you receive the advances under the earlier regime, you are liable to pay the taxes, but you have not commenced the project. So tomorrow, whenever you are going to procure the material for construction after 1/4/2019, whether out of that basket of input tax credit, can I pick up some part of my input tax credit to set off with those taxes which I've already paid prior to 31/3/2019. I'll repeat again. For example, as on 31/3/2019, say project has not, I have not started the construction, but I have already received the advances from the customers. Yes, am I fulfilling the condition of ongoing project first? Am I fulfilling the condition of ongoing? Yes, presuming that I'm fulfilling ongoing project. I am receiving the consideration from my customer, but I have not yet constructed the project. I have not yet begun the project, or I have done in a very, very small part of the construction has happened. Whereas the advances have received in a huge. I've already offered the taxes out of say 5 crore project. I've already received 2 crore advances from my customers. Whereas I've already hardly done some 5 lakhs work in that project. So in that case, as already I have paid the taxes on 2 crores as GST, whether I should enjoy the input tax credit, which might be procured after 1/4/2019. Yes, which might be procured after 1/4/2019, but already I have paid the taxes on my advances. Whether there is any mechanism in the GST law which says that, yes, if you are procured after 1/4/2019, though you are opting for the new rate of tax, can I pick up some input tax credit from that basket and say that, yes, to this extent I will be eligible, because to this extent of credit, I have to set off with the advances, whatever I have offered it. So there is a certain mechanism they have come out. So what they have said, you have to look 3 criteria. One is, what is your percentage of invoicing you have done prior to 31/3/2019? The second aspect is, what is the percentage of completion you have done on 31/3/2019? The third is, what is the consideration you are received up to 31/3/2019? And also they have said, if your procurements are more than consumption, you would have procured a lot of material, but if your consumption is not there, then what is the input tax credit you are supposed to enjoy? I think this is what they have come out in a computation of Annexure 1 and Annexure 2, which is talking for REP project and RREP project. I will tell you, very, very interesting. It is giving us the mechanism for us to pick up the input tax credit from your total basket to arrive that, yes, to this extent, I am going to enjoy my input tax credit up to 31/3/2019 based on this criteria and based on these conditions. They have come out with one more conditions. They said, okay, you have done only invoicing. So, but your invoicing is more than your percentage of your construction. Then we will give you one mechanism to arrive. Okay, whatever the construction you have done, plus 25% you add it to that. That will be your value. Okay, if you have received more consideration, if you have received more invoicing than your consideration, okay, do with the estimation of consideration plus 25%. They have come out with a special percentage for this. Yes, we believe it. I think they have come out with a certain real estate standards. They have come out with a standard. Yes, this might be the proportion. This might, for this kind of out of 5 crore project, if you have already received the advances for 2 crore, and if your completion is only say 10% of that, that is to say 20 lakhs, then possibly, okay, we'll add it that to the 25%. To that extent, we believe that yes, to that extent, you would have set off with your liability. I believe this is looked to be little on a notion basis or estimation basis. It may not be accurate, but there are certain standards. I think they would have looked into that before coming into the conclusion of adding 25% to this kind of criteria. So most important is percentage of invoicing, percentage of construction, and percentage of consideration received plays very, very important role as on 31/3/2019 to decide, yes, to this extent, you should enjoy the input tax credit. So I think this is the most welcome. I really enjoyed when I was looking into that annexure and formulas where they have arrived in such a manner that when I did that computation, I was able to understand, yes, based on this, they want to give certain input tax credit because I've already offered the taxes under the earlier regime, but I have not enjoyed the input tax credit because I have not done the construction to the extent of what I have raised the invoice to my customers. I think that is the way the Annexure 2 has specified. Annexure 2 is specifically for RREP project, where the computations are given based on your residential area sold and to what extent your work completed, to what extent invoicing has been done. I think if you look at Annexure, you will come to know the computation of your input tax credit. So I request the members to look into that. I did not bring intentionally into this because I don't want to confuse you more. And I want to give you the concept before you look into that annexure, so that you will understand what is the intention behind adding this annexure 1 and annexure 2. And this was required to be done up to 30th September 2019. So I believe that most of the members would have done already for this up to September 2019. So that's why I have not taken in detail for this slide. But I request the members to kindly re-look into that so that whenever you are going to do 18-19 audit, you can consider even that aspect also. Then option to reverse such credit or take credit in future. Already I've told you, if you have enjoyed the excess credit up to 31/3/2019, law stated, okay, you reverse such credit. But if you have not taken that credit, you enjoy that credit in future, even though you are not eligible, but you will be made eligible based on this notifications. So please look into this fact actually. And explanation to Rule 42 is saying, what is exempted area? They said exempted area include carpet area on which tax is payable at new rate. Why I brought this? Even if you're paying the taxes at new rate, that supply is also called as exempted supply for the purpose of reversal of input tax credit. Please note this important point. This is a quite illusionary, but this is what it was there even under the SENVAT credit rules where you were opting for abatement. Similarly, for GST also, they brought it. Okay, if you're enjoying instead of 12%, you're paying 5%. Okay, that supply is also a exempted supply for reversal of input tax credit. Please understand it is only from the perspective of input tax credit I am stating on that. Even unbooked apartment is considered as exempted. That we are very clear on that. And no reversal of credit on monthly or final after receipt. Why is it no reversal? Because already whatever you are supposed to do for the new project, you've already done on 31/3/2019, where the time was given for you to compute up to September 2019. If you have already done the computation, anyway, you are opting for the new rate of taxes. And very clearly, the law has stated that exempted, whatever the new rate of taxes you are charging for your supplies, even that will be treated as an exempt supply. So there is no question of reversal of credit under Rule 42. because anyway, every month you are not eligible itself. So nothing you have carried forward till the date of completion certificate or the till date of your first possession. So there is nothing, no question of reversal of your input tax credit. That is very clearly in Rule 42.5. They said, yes, you are enjoying new rate of taxes. That new rate of taxes is without any input tax credit. You are not carry forwarding any input tax credit. Why? Because you are charging new rate of taxes. That new rate of tax is nothing but it is a exempted services. So based on that, no reversal of credit on monthly or final basis for RREP projects when you have opted for new rate of taxes. Yes, I think to a certain extent, I'm just trying to make you clear that what you're supposed to do as on date also for this kind of project. So anyway, we are clear. And please remember, every computations we are doing on monthly basis also. So whenever you are going to do for this kind of tax, anyway, it is reversed every month. So I think you have to do only month on month basis. Nothing will be eligible because everything will become as an exempted supply here. So based on that, there is no question of input tax credit. Other than that, if there is any other taxable supply, then I think that you can consider. But here from the construction services perspective, I'm talking that it is purely an exempted supply. So no question of common credit, no question of reversal, no question of interest, nothing is there. Treat it like an exempted services and treat it like your input tax credit as your cost, and accordingly you can carry forward. You can take it. So it will be reversed totally in your books of accounts. So even for this also, when you're going to opt for, please remember Annexure 1 and Annexure 2, they have come out only for inputs or input services, according to my view. They have not clarified what we are supposed to do on capital goods as on 1/4/2019. If you look into the annexures where they have clarified more on inputs and input services, so but we have to understand what we are supposed to do for capital goods also, because till 31/3/2019, I would have treated it as a taxable supply. After that, my project has gone into new rate of taxes, so it will become like an exempt supply. So my capital goods life is 5 years, let us presume. 2 years I have used prior to 31/3/2019, and 3 years I'm going to use post to 1/4/2019. So should I reverse that input tax credit on 1/4/2019 itself, or should I reverse the credit every month? Please remember, it has to be done every month on the portion, because you don't know which capital goods and what is the life of asset of that capital goods. You have to arrive based on each capital goods, and accordingly you have to compute based on monthly basis. Monthly basis, you have to arrive your exempted supply, and accordingly you have to reverse the credit. Why I'm saying exempted supply month basis? Because every month you will have a exempted. It means any flat you are going to book after 1/4/2019, it is going to happen as an exempt supply itself. So every month you are supposed to do it on to the capital goods after 1/4/2019. So please be careful. As on 31/3/2019, please do the working of capital goods. See when they are procured. If it is procured prior to GST regime, don't worry on that. But if it is procured under the GST regime and you have opted for the new rate of taxes, please, you have to compute the life of that capital goods, and you have to reverse the input tax credit for the balanced life of your capital goods. Say, for example, in Jan 2019, you have procured it. So Jan, February, March, 3 months, you have enjoyed that credit. So you are supposed to reverse for 57 months. So every month, you are going to reverse the input tax credit to the extent of your exempted supply in each month. So this will be a big exercise under Rule 43, especially for a RREP project or REP project. I think this is a task which we have to look into that for reversal of input tax credit for if any capital goods are purchased. Here they have used the terminology as capital goods purchased based on the date of invoice. They have not said when you are put into use. Please remember, here the life of capital goods of 5 years, we have to compute from the date of purchase of that capital goods, from the date of invoice of that capital goods. So this 5 years had to be calculated from the date of invoice of capital goods. So accordingly, the recomputation has to be made for that. The credit reversal is required to be done for carpet area ratio. So whether it is an input or input services or capital goods, all the reversals has to be done based on your carpet area basis. Just 1 minute of you I want to take for this capital goods. They just want to tell that I've already told you that life of capital goods is 60 months. So you have to identify what are the capital goods on which there is a life for the balance year after 1/4/2019, and accordingly you have to appropriate between the exempted supply and taxable supply. So here we will be having E1, here we will be having E2, here we will be having E3. I think I've already spoken on this E1, E2, E3, but just for the benefit of members, just to recall you, E1 is nothing but the flats on which you have opted for new rate of taxes. E2 is the one value of those value of that input tax credit for which you have enjoyed the input tax credit up to 31/3/2019, and the extent of credit which you are supposed to reverse after 1/4/2019. That is called as E2. And E3 is nothing but to the extent of unsold flats. So for capital goods, we have to do the reversal considering E1, E2, and E3. This will be applicable only when you are opting for a new rate of taxes. Yes, I think members are clear on this. E1, E2, E3, this formula will be applicable only for the project for where you are opting for the new rate of taxes. So I think this is what E1, E2, E3 we have to calculate on the overall project basis, and accordingly we have to reverse the input tax credit as the on the date of receipt of your completion certificate. So this formula I have given here, how to compute it. So E1, E2, E3 we have computed, and accordingly final reversal has to be made on 31/3/2000, whenever you are going to receive a completion certificate. Yes, sir?
Yeah, you can continue, madam. No problem.
So now understanding the concept of this RREP project where I have opted for new rate of taxes, where I'm doing the reversal of input tax credit to the extent of my exempt supply, whether I am supposed to do on the date of occupation certificate. Please remember this capital goods reversal you are supposed to do every month, and as well as you are supposed to do on the date of receipt of your occupation certificate also. Please remember, because you are supposed to do every month, because every month you will be having a exempted supply. What is that exempted supply? Whatever you are charging the new rate of taxes, to that extent it becomes an exempted supply. And as on the date of completion also, you will have certain apartments which will remain as unsold. So even that will also become as an exempt supply. So hope I am just trying to make you clear. I think this formula, if you go through in simple way, you will get to know. But just for the benefit of members, I have taken one illustration. Say final reversal, if you can read in the slide, below part, the final reversal is, say for example, the carpet area is 1 lakh. Out of that, sold after 1/4/2019 is 25,000 square feet. So carpet area which remained unsold is 75,000. So what happens? What they are saying is, so out of that 75, I think this is 35,000, sorry, carpet area which remained unsold as on the date of completion certificate is 35,000. So out of 1 lakh, 25 plus 35 is 60,000 is already after 1/4/2019. So prior to that, there is a 40,000 which is sold up to 31/3/2019. I think members are able to understand this, because out of 1 lakh, we have already sold 25,000, 35,000 is unsold, and 40,000 is sold prior to 1/4/2019. So for this 40,000, we have to arrive E2. Why? Because to the extent you have sold as on 1/4/2019, you are supposed to compute the input tax credit for that 40,000 square feet, because you are going to receive the consideration even prior to 31/3/2019, even after 1/4/2019. So what the law is saying, whatever you are receiving after 1/4/2019, for those projects, you are supposed to reverse your input tax credit. So you will be enjoying the input tax credit only to the extent of consideration or the time of supply which has occurred prior to 31/3/2019. Please let us look. This is very, very important for all of us to understand. The carpet area is 40,000. Please understand, for which this is the apartment which is sold prior to 1/4/2019. For this 40,000 square feet, I have received consideration of, this was sold for 5 crore. So for this 5 crore, I received only 3 crore up to 31/3/2019. Balance 2 crore I have received after 1/4/2019. So the law has said that for the balance 2 crore, you are liable to charge at 5%. So when you are liable to charge at 5%, you are supposed to reverse the input tax credit even to that extent of the consideration, the demand, the time of supply which has occurred after 1/4/2019. So I think this is very important for all of us to understand and compute this time of supply as on 1/4/2019, especially for capital goods. So finally, we arrive E1, E2, and E3. So E1, we have arrived to the extent of the flats which we have charged at new rate of taxes. E2, we have arrived to the extent of the
Okay, ನಮಗೂ ಕೊಡ್ತಾನೆ ವೇಟ್ ಮಾಡಿ. Hello, dear members, kindly bear with us. There is an internet connection problem at the speaker end, so I request you to wait for few minutes. We are waiting to connect for the connection from the speaker, and there is a internet uh, problem. Dear members, the tomorrow session is on the opportunity available for CA and SMEs via NSC Emerge platform, and how SMEs can tackle issues related to delay payment by Mr. B. Gauri Shankar, Regional Head BD South, National Stock Exchange of India, and CA Yogesh Jain is going to address. Dear members, kindly make note that all our PPTs for the programs has been updating in our website. It has been regularly in the source.
Sorry, members. Sorry.
Yeah, madam is back.
Yeah. Sorry, there was some internet trouble.
Yeah.
Yeah, sir. Just another last slide. I'll just share it, sir. Then I think we can go for questions. Just last slide. Uh, yeah, members, I think I've either convinced you or confused you. Just want to make you clear the quite concepts of this. I think this is a more mechanism we are looking for this. The last option is the same real estate project. The only difference with the earlier project and this project is in REP project, we'll be having a commercial flats and residential flats. Now the most complex will arrive in these fourth options because for the residential flats, you will not enjoy the input tax credit. Whereas for commercial flats, you will be enjoying the input tax credit even after 1/4/2019. So I think every month you have to bifurcate your input tax credit pertaining to your commercial flats and pertaining to your residential flats. And then accordingly, you will be enjoying the credit only pertaining to your commercial flats. I think this is a very task for all of us to compute the input tax credit, especially in case of real estate projects, which has both commercial flats as well as a residential flats, and where you have opted for new rate of taxes, because as we all know, new rate of taxes can be opted only for residential flats and not for commercial flats. So this is the way I think the mechanism is given for here. It is more or less like a third option only. Only thing is we have to consider the commercial apartment share also for computation of reversal of input tax credit. So you have to compute your input tax credit from July 2017 to March 2019, including your transitional credit. Plus, you also have to compute the input tax credit from 1/4/2019 till the date of completion of commercial apartments. Because for commercial apartment, completion certificate will play important role because you have to apply on a regular basis. Whereas for residential apartments, it will be like a reversal of input tax credit every month. So I think this is the way we have to calculate for Rule 42 when they have opted for new options under the REP projects. This is for input and input services. Capital goods also, it is the same way what we have computed in the third option. Similarly, also here also we have to compute E1, E2 and E3. So whatever to the extent of exempt supply, we are going to reverse it on the final reversal. To the extent of eligible, that is commercial apartment, to the extent of sold, you can enjoy. To the commercial apartment, to the extent of unsold, you are supposed to reverse for REP under the new rate of taxes. So I think once you understand the concept of that Rule 43, E1, E2, E3, you can easily compute the capital goods and accordingly you can reverse the input tax credit. Please re-look into the prerequisite of the informations and accordingly you arrive the manner of determination of your input tax credit and reversal thereof under Rule 42 and 43 based on the type of project and type of rate of taxes the project is undergoing, so that accordingly the computation of input tax credit will be arrived under Rule 42 and Rule 43. So I've just made a slide for the benefit of members to understand which notifications, which rule we have to apply for computation of your reversal of your input tax credit. I think members can refer this sheet also whenever they are going to look into this actually. So just 5 minutes before I take your questions. Whether eligible credit should always be on carpet area, why not we have considered the sales value? Because it is believed that you get more accuracy of your input tax credit based on carpet area, not on sales value, because sales value will be variation mode and we may not be able to exactly compute the eligible input tax credit. That's why they have taken a carpet area basis. And whether reversal for 17/18, what we are supposed to do prior to 1/4/2019, they have not clarified anywhere, but according to my view, you should still reverse based on your carpet area basis, even prior to 31/3/2019. Whether computation for each project separately, yes, we have to compute the Rule 42 and 43 separately for each project. Computation on monthly basis and not annually. You have to, depending upon the type of project, you have to decide where the monthly basis formula has to be applied and where annually it has to be applied. Accordingly, you have to work on monthly basis and annual basis. Whether 1/3 of deduction for land can be taken as exempt supply, we have already discussed. If this is a litigation issue on this, but if you think any common expense which you have used it for the both kind of supply, I think to that extent you can show it as an exempt supply. And the most important aspect I was looking into when I was reading the rules, they have not amended the sections, whereas they have amended the rules for real estate. So I think there is a requirement to amend in the law also, amend in the sections also, especially 17.3, to bring more clarity on exempt supply. So I think that is what we are looking from that. And I think the shortfall of 80%, we have to wait for the annexure. And just for the information of members, we are supposed to calculate by the June of this month for the shortage of input tax credit for 80% purchase from registered person. I think this we recompute the credit, and please see that by end of this June, we compute the liability accordingly if there is any shortfall of that. So I think we have to just wait for the annexure, but at least computation can be computed for this shortfall of 80% of from registered person to compute as a liability. So I think this was the macro analyzing I was able to give within a short span of time on rule 42 and 43. It is quite vast. When we compute it, we get to know a lot of issues we are getting. But what I understand is if you understand the concept and mechanism, then I think it will be easy to apply the formulas, and accordingly we can compute the tax credit and reverse the input tax credit according to the manner as has been specified for real estate industry. So I think with this, I hand over to the chairman, and I request the members, if you have any issues, you can just let.
Madam, I think for me it is four questions is pop upping here.
Yes, sir.
So it is an what is the GST rate for the landowner under JD prior to 1/4/2019? Can landowner pay 5% GST?
See, prior to 1/4/2019, there was no question of 5%. 5% has arrived only after 1/4/2019. So 5% rate can be enjoyed even by the developer, 5% rate can be enjoyed even by the landowner as long as they are providing a construction services. 5% is not applicable prior to 31/3/2019.
And dear ma'am, if the company has input credit of rupees 4 lakh as on 31st March 2019
Yes, sir.
and has not commenced the project till March 2019,
Yes, sir.
company still is in process of getting project approvals and opted for new scheme of 5%.
Yes, sir.
And
So I
not
think, yes, sir.
and not started the project till date, that is June 2020, and expected to commence by December 2020. What will happen to input credit of rupees 4 lakh and company has only this project, no units sold or advances received, not done anything related to
I
same?
think it is advisable for that companies to show it in their monthly return and carry forward and get it credited to their credit ledgers. So once the project is commenced and once the taxable activity is done, then accordingly they can set off their input tax credit against the tax liabilities. So they can carry forward, sir. There's nothing to be written off as such. Once the project is commenced, as long as they're procuring, they have not commenced the business. Once they're procuring, let them get registered under the GST law and let them disclose in their monthly returns. So once the project is commenced and once the taxable activity has taken place, they can adjust this input tax credit against that liabilities.
The statement that the competition should be each project is confusing. There is no clarity like that.
No, it's see, we have to understand. We have to look this from the RERA perspective also. Whenever we are seeing, for example, there are 5 towers. Whether all 5 towers are covered under one project or whether each tower is covered under each project. That way we have to compute. If all the towers are under the one project, then the computation of credit has to be made under one project. So we have to see how it is project under the GST law as well as with the RERA. So for this project wise, you have to look RERA also, how it is determined under RERA. So if it is a project under RERA, it will be project under GST law also.
In all the slides, explanation given shows that it is for the registered person and not for any given project. Please clarify.
Not for the, yes, sir.
Not for the not for any given project. In all the slides, the explanation given shows that it is for the registered person and not
Yes,
for any given project. Please
yes.
clarify.
I think we have to understand that it is only for the registered person. Only registered person can enjoy the credit. Unregistered person cannot enjoy the credit. So I think it's right actually. I don't know what he meant to ask that question.
Yeah, yeah. And does the project need to have approvals for utilities like electricity and water connections before first possession can be given?
See, let us understand that they have not defined first possession. But as long as if it is ready to stay, ready to occupy flat is there, then I think that can be called as a first possession. And I think ready to occupy will be done only when there is a electrical fittings and sanitary fittings are there. It should be ready to use. It is not something like ready to occupy. You can use that apartment also. So if, to that extent, if that flat is ready, according to me, that will become as a first possession. So I think electricity and all are required actually.
Okay, that four questions, madam, pop up in me. One second here. Members have given again. Company has an input. Can be given. Yeah, the same questions. 4, 5 questions of showing to me.
Yes, sir.
If any questions in question answer, madam, kindly look it, because I lost the connection also sometimes. Okay, so that's all the questions, madam.
Yes, sir. Anybody want to ask anything or else
Yeah,
either
is
um,
Divya there?
I
Yes,
just
sir.
want to, yes,
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 sir.
Please come.
just Divya, 1 minute. I just want to convey to the members that I think this was the overview what I have given in the slides. I request the members to go into the specific provision and apply it accordingly. I've tried to give the illustrations, which is only illustrative. So based on the understanding of the provisions, based on the understanding of Rule 42 and 43, we have given the illustration. So we request you to the members to go through the slides again, understand the mechanism of reversal, and I think that will make you to understand, make us all of us to understand Rule 42 and 43 in a better manner. Yes, sir. Thank you, members, for patience.
Madam, few
Yes,
more questions. I think. No, I think it is. What is the rate for the landowner under JD prior to same question? I think.
I think it's the same question, sir. I
Same.
think.
Yes, yes, yes,
Yes,
madam.
sir. Yes, sir.
Thank you, madam, for your valuable time for
Thank you
sharing.
also. Thank you, Bangalore branch. Thank you, members, for patience
And
listening. It is
yeah,
not
it
easy to
was
listen this. Yes, sir.
it
Thank you
was
all. Thank you.
a very good informative session on the
Thank you.
very realistic topic
Yes,
and
sir.
very critical topic. Members always the ITC where the money we are paying from our pocket, and
Yes,
again the trouble we are facing for the, and definitely our chartered accountants friends have got benefited for this our
yes,
Jnana
sir.
Dasova program.
Yes, sir.
So I wholeheartedly thank you, madam, from
Thank
on
you.
behalf of
Thank you,
Bangalore
members.
branch,
Thank you, Bangalore
and
branch.
I thank all the viewers. Dear viewers, tomorrow we are having session again at 4 o'clock. Is Divya is there? Please kindly.
Yes, sir. Available,
Yeah.
sir.
I request Divya to propose formal vote of thanks to the Madam Annapurna Madam and all the viewers.
Thank you, Chairman. On behalf of Bangalore Branch Managing Committee, I would like to take this opportunity to propose a formal vote of thanks for today's webinar. First of all, thank you very much, Madam, for sparing your valuable time and sharing such an informative session.
Thank you, sir.
Thanks once again on behalf of Bangalore Branch to you. I also thank all the participants for your patience hearing and active participation.
Yes.
Madam, we are hoping to back once Corona is over. We have to many
Sure.
sessions is pending for the GST, and
Yes, sir.
there
Definitely.
is many critical issues are there.
Yes,
So
sir.
hope due to head office is restricted for only 10 VCMs per month.
Yes, sir.
So, but at least we are covering at least 2 to 3 topics. 3 topics will be from on
Yes,
GST
sir.
only.
Yes,
So
sir.
hope to have your sessions
Definitely,
upcoming
sir.
days. Once again, I wholeheartedly thank you for
Thank you.
sparing time,
Thank you.
and
Thank you.
thank all the
Take care,
viewers.
members. Thank you. Thank you.
Thank you, madam.